some of us can be brought to speed as regards what we've done so far. We've been treating group accounts, and we're looking at consolidation of financial statements of the parent and that of the subsidiary. And we said that the simple rule of consolidation is this: if an investor in the equity interest of another company has invested beyond 50% of the total equity or the outstanding equity holdings, that company qualifies as a parent, that investor qualifies as a parent. And when they qualify as a parent, the onus lies upon them to prepare and present a consolidated financial statement. All right. And we went on to consolidation of financial positions. And we said, to consolidate financial position, you must understand that you are bringing out one financial position that captures the entirety of the group. The entirety of the group. It does not matter whether the parent company only owes 51%. In as much as they have crossed 50%, you are going to do what we call full consolidation. And that simply means that you're going to be adding up line by line items of assets and liabilities of the parent and the subsidiary. All right. And we said to do that effectively, you must follow the principle of cancellation. I said that is the overarching principle that guides you into everything you want to do. And we have seen different forms of cancellations so far. What we are calling adjustment is still cancellation. I said once you are putting out a consolidated financial position, any transaction that could be represented on the financial position of both the parent and the subsidiary, that is a transaction between the two of them, must be cancelled out. And the first point of cancellation usually will be the consideration that the parent company paid to acquire that subsidiary. And that cancellation will bring you to what we call goodwill on consolidation, or it could bring you to what we call gain on bargain purchase. Goodwill on consolidation means that the parent has paid an amount that is greater than the fair value of the net assets of the subsidiary, meaning that they have paid a greater amount. We said that must mean that there is an intangible asset there that they see, and they decided that, okay, because of the reputation of this subsidiary company, will not mind paying over the premium. All right. And then we went on to say you could also have a case where the two companies have traded between themselves. One party is expecting money from the other one, a cash payment or the transfer of goods from the other one. And we said whenever that happens, it means that you would see that transaction on the account payables of one of the two of them, and you see that same transaction represented as an account receivable on the other part. So what do? You cancel out. Now, when you are canceling out, the question will be, what if the amount on the receivable end is higher than the amount on the payable end? We said that should intuitively mean that the owing company, whether it's a subsidiary or the parent, is believed to have transferred the money. However, it has not come into the record of the one who is supposed to receive that money. So we call it cash in transit or goods in transit, all right? Or you can call it goods in transit. Goods in transit, all right? Okay. Then We also went on to talk about other forms of adjustments that may come in. We said you could have a situation whereby as at the day of acquisition, there could be other assets that will form part of the net asset of the subsidiary that was acquired. And we said things like brand name. Now that brand name that is coming in, it was not in I explained this from the angle of IAS 30, is it 36 or 38? IAS 38 rather, intangible assets. And I said one of the conditions to recognize an intangible asset is that you must be able to trade that asset in a separate transaction. Now, as a going concern, it may be hard to value brand name, all right, and sell that brand name in a different transaction. But when it comes to mergers and acquisitions, whenever acquisition takes place, in as much as the acquirer is willing to pay for this brand name, then it now qualifies as an intangible asset. So therefore, you may not see it on the book of the, what is it called now, on the separate financial statement of the subsidiary, but whenever you are doing consolidation, it is now going to come in. Of course, it will be subjected to yearly or periodical impairment tests, all right? Now, we said all of these things. I'm just trying to, bring our mind back to what we are doing. Another thing that we have consciously always repeated in the class is that we should be mindful of the date of acquisition. What is the date of acquisition and what is the date of consolidation? Because that may affect how we are going to present our consolidated financial position. It may affect as well the adjustments that may be necessary for us to make. All right. We are pushing up. We've made some simple, what is it called now? Assumptions. But now we are getting into the ticker aspect of things. And I expect every one of us to be on board. All right. Okay, let's move on. Now, what we want to look at is a case whereby the parent has done a transaction which could be is let's not even could be is a sale of inventory item. Is a sale of inventory item between the parent and the subsidiary. And what we said is this: whenever this happens, it could be that the parent is transferring goods to the subsidiary at the very cost, or they could be doing it at cost plus markup, meaning that there's going to be a profit loading on the price that they are going to transfer the goods to the subsidiary. Are you getting my point now? Now, should that happen as at the date of consolidation, what it represents is this. What it means is that this guy has claimed to make a sales, but what was sold is still an inventory item in the book of the subsidiary, meaning that the goods that was transferred from the parent to the subsidiary, all of that inventory or part of it is still in the separate book of the subsidiary, and we want to consolidate. Now, you will agree with me that if you are following the principle of cancellation, it therefore means that we should see that item of inventory that is still in the book of the subsidiary as a transaction that happened within the group. So therefore, we ought to cancel out that item, any element of profit that is on this inventory. any element of profit, so that it will be impossible for us to have made profit within the group, because the group is one. So it should be impossible for you to trade with yourself. I cannot trade with myself. So if we see the group as one, then it should be impossible for the group to have made a profit in a transaction that is within the group. So when I'm making my consolidated statement of financial position, I am expected to eliminate that unrealized profit. It will be called unrealized profit. So I'm supposed to offset that. And how do we offset or eliminate that? We said in the last class, because I remember I made an introduction to this, I said you should take it away from the parents or the group P or L, and the representation of the P or L in the statement of financial position is the group retained earnings. All right, that's the unrealized profit there. And then you should credit inventory to reduce the amount, the unrealized profit element that makes up the inventory value. All right, so this is what we simply do. However, if it is the subsidiary that has made a sale, if it is a subsidiary that has made that sale to the parent, and now it's the parent that is carrying the inventory, the item of inventory. All right. Now, don't forget that any profit that belongs to the subsidiary is supposed to be shared between the parent and the non-controlling interest. Okay, so in that instance, yes, I am still going to debit the group retained earnings. However, I am only going to I am only going to debit group retained earnings by the portion of control, the controlling interest, the holding. If it is 80%, then we'll only have 80% of the unrealized profit debited to group retained earnings. The remaining 20% will debit it to NCI, and then we credit inventories. We credit all of the unrealized profit from the inventories. All right. So this is what we're just going to demonstrate now.
Hello, sir.
Go ahead.
Please, for God's sake, just come again on that last point, sir.
All right. Okay, so this is what I'm saying. I'm saying that in an instance where it is the subsidiary that has made a sale to the parent. Now, meaning that in the book of the subsidiary, in their separate financial statement, they have recorded a sale. And that sale, there's an element of profit there. All right. Let's say, for instance, they sold at 20% profit loading to the parent. To the parent. Now, as at the day I want to consolidate, the parent still has some of those inventories or all of those inventories in their book. Now, the sale of inventory to the parent is not the problem. The problem is that there is an element of profit, all right, that is belonging to the subsidiary. So what do we need to do? We need to write back that unrealized profit in our consolidated statement of financial position. Now, in writing it back, I'm now saying that don't forget that any unrealized profit that belongs to the subsidiary belongs to the parent and the NCI. So I now said, if the parent has 80% holdings and NCI has 20% holdings, it means when I am debiting group retained earnings, I will do 80% of the unrealized profit debit to group retained earnings. The remaining 20% of unrealized profit, I will debit it to NCI, while I will credit inventory in the book of the parent. 100% of unrealized profit, I will take it away from the inventory. Is it clear now?
Yes, sir. Thank you, sir.
Right.
Can I say something, sir?
Go ahead, sir.
Thank you. God bless you. So it means that if the parent sold to sub, we only debit the retain earning of the parent. But if it were to be that the subsidiary that sold to the parent, we will debit from both the parent and the subsidiary based on their holdings, percentage holdings.
Yes, parent and NCI, not subsidiary. Parent and NCI.
Thank you,
All
sir.
right.
Thanks.
Exactly. That's what it is. All right. So let's move on. Let's see what we can use to demonstrate what I have explained. I understand it may still not be so clear to some people, but I think it should be easy. The double entry to eliminate this unrealized profit is what they have summarized here as well. Okay, let's see question here. All right, we're told problem number 16, intra-group profits. Okay, we're told PICO has owned 75% of the shares of ESCO since the incorporation of ESCO. Now, during the year to 31st December 2017, ESCO sold goods costing 8,000 naira to PICO at a price of 10,000 naira. You can see already you are told here, ESCO sold goods to PICO. Now it cost them 8,000, but they have sold it for 10,000, meaning there is an element of profit here amounting to 2,000 naira. Now the next thing I need to find out is, did these goods, what portion of these goods still remain in the books of PICO as at the date I want to consolidate? Is it all of it? Is it some part of it? Or is it that PICO has sold everything through so that there is no element of unrealized profit? Okay. Now, if you go on, they said, and these goods were unsold by PICO at the end of the year. So if I am to consolidate at this end of the year, all of this 10,000 naira, what inventory in the book of PICO, there is going to be a 2,000 naira unrealized profit that I need to eliminate. All right. And we already know how we are going to eliminate it. It's simple. We're just going to, because it is subsidiary that are sold to PICO, we need to make a distinction between what portion are we going to debit the group retained earnings, what portion are we going to debit to NCI, and the last will be to credit inventory with the whole of the 2,000. All right, let's move on. Okay, and now we're told the statement of financial position of the two companies on 31st December 2017 are given below. All right. Required, prepare the consolidated statement of position of financial position of PICO at 31st December. The fair value of the NCI at acquisition was 12,500, meaning that NCI is not valued at proportionate share. Instead, it's fair value, and they are giving us that fair value free of charge. All right, okay. So it's the same thing we've been doing all along. All right, let me get a second device here. 1 second. I'll just use my phone. Just give me a second. Let me share whiteboard so that we can all follow. For the sake of those of us who are new in this class, we said we'll be using whiteboard. All right, and that means me using whiteboard means you must have the question right beside you. so that we don't run into the issue of where are you picking the numbers from? All right. Okay, I think I have my device ready. All right, let's get into it. I'm picking whiteboard. Why is it not coming on? Aisha, how are you? Aisha is here, right? Okay, let's get to it. All right. So first thing first, what is the group structure? Like I always say, that's the first thing I look at. What is the group structure? What's the structure of this group? All right, I'll have to go back to the question. Somebody use the chat box, page 71. All right. Yeah, I'm on there. I think it's even page 72 I am on. All right. Let me go back to the question again. They said Pico owned 75% of S. Pico owns 75% of Expo. All right. Now, did they give us any other thing? They said they have always owned it from, so date of acquisition is since incorporation. All right. Meaning they will have access to all the retained earnings of ESCO. All right. Any other special information? Okay, that means they won't have retained earnings as a date of acquisition. I think this one is straightforward and simple. They just want us to get into it. Okay. Goodwill on consolidation. Goodwill on consolidation. FV of consideration paid. All right. Now, the question did not start with that opening a paragraph that tells you how much was paid. But what you can do is go to the statement of financial position of PICO. You will see investment in 37,500 shares in ESCO at cost, 37,500. All right. Now, NCI, I don't need to sweat it. They told me NCI was what? 12,500. Okay. Everything here should amount to 50,000. Okay. Net assets. Net assets. Net assets that was acquired was the ordinary share capital. Ordinary share. Sorry. Ordinary share capital. We're told is 50,000. All right. It is impossible for them to have any retained earnings as at the day of incorporation. It's not possible for them to have had any. So we come here. So this really means that there was no goodwill, neither was there any gain on bargain purchase. So I can quickly move on to what is called the group retained earnings. All right. For group retained earnings, I'm asking myself, as at the date I want to consolidate, what is, I can see as per account that I was given, the financial account I was given two companies. All right. Retained earnings for Pico was 75,000, while that of Esco is 30,000. All right. Now, was there any pre-acquisition retained earnings? For Esco, there was none. So we get to share in all of these 30,000. But just before we go there, hold on. So all the 30,000 is post-acquisition. However, we're told that they loaded goods costing 8,000 naira. They sold it for 10,000 naira. And those goods remain unsold in the book of Pico. All right. So what I will do, I have told you when you are doing your group retained earnings, any adjustments that affects both the parent and the NCI, I will make that adjustment on the subsidiary line. Okay. Now, what adjustment am I making here? Unrealized profit. Unrealized profit. And what is the unrealized profit here? We sold, subsidiary sold for 10,000, goods costing 8,000. So therefore, the unrealized profit here is 2,000. Therefore, all that is left to share is 28,000. Now, parent share will be 75%. All right. Now, what is 75% of 28,000? I think that should be 21,000. So we take that 21,000 there. So the group retained earnings will come to 96,000 naira. As for NCI at date of acquisition, NCI was 12,500. Their own share of this 28,000 will be the remaining 7,000. No need to sweat it. It means NCI will be what? 19,500. All right. And what is left for us to do will be simply to consolidate. All right. Okay. Now, for us to consolidate, can I erase everything and move on? I think it's pretty straightforward. Can I erase and move on?
You have to share with us later, so don't erase. Open another page.
So it will be impossible for me to open another page. You know, I'm sharing a whiteboard.
Exactly.
All right. Well, I believe we should be able to capture everything. All right. Let me go on back. Maybe I will just go back to what we were doing. How do I consolidate this? It's straightforward. They didn't give us any special adjustment to do. So I'm simply adding these ones. And I have 122,500 here. This has been cancelled out when I was trying to calculate the goodwill on consolidation at the date of acquisition. Okay. So I don't have anything on this line. I'm not doing investment in subsidiary when I'm working with consolidated financial position. All right, my inventories. Don't forget that this inventory that belong to Pico, we'll need to remove 2,000 from there, Abi?
Yes,
so
sir.
We'll be left with 23,000 there. 23,000. So that 23,000 is what I'm going to add to 24,000. And that should give me 47,000. All right. When you come to receivables, Your receivables should be 18,000. Come in, let me just put it out here. Your receivables should be 18,000. So when you add all your assets together, you should have 122,500 plus 47 plus 18.
187.
187,500, Abby.
18,000 what for that inventory?
What did you say?
18,000 plus 47,000
Yes.
plus 122,500.
Yes. What do you have?
187,500.
All right. 187,500. Okay. Now, if I come down to my ordinary shares, I'm only going to pick up, this one is basic. I'm only picking this one up, Abby. So this is 40,000 here. My retained earnings is now 96,000. All right. If I add that together, I have 106. Okay. Let me do it by another side. I have 40,000. Retained earning is now 96, making 106,000. Then don't forget your NCI, 19,500. Okay, that should make 131,500. Right? And then we have current liabilities of 32,000. What did I miss out on?
Hello, sir.
Hello, I'm with you.
The retained earning is how much?
Was it not 96, or how much did you calculate?
96 plus 40. That's 136 now.
Oh, sorry. I thought you said 106.
I didn't say that, you, not me, sir.
136. I was already asking myself, what did we miss out on? All right, 136,000 plus 19,500. This should give us how much? 145,500. Is it 145? 155. So you add 32,000. That's the addition of these two. And you get 187,500, which is your total asset as well. So it's as simple as that. This whole example or this problem is just simply testing intra-group profit. That is all it is testing. There's no big deal there. Can I move on? Can I move on? Nobody's answering me.
Nobody can answer for others.
I want you to answer for yourself. Mr. Latif, should I move on?
You may, if other permits you.
Madam Aisha, I've not heard your voice today. What's happening?
I joined late. Don't worry, I will soon pick up.
All right. Or people have given up on this class and said it will not hold. So maybe perhaps. let me see. Jacinta, are you in the class? Do you have any problem with it? I don't think anybody should have problem. But if you do, please let me know.
No, sir.
All right. Okay. I think I'll just move on. People don't want to talk. Even my Alexa doesn't want to talk to me. What's happening here? Alexa, is it fine? Alexa, are you there? She was the first to join the class. I think I met her in the class already. Alexa.
Yes.
Maybe Alexa is asleep already. All right, let's move on. Okay, let's quickly look at the second problem. Let's quickly look at that. So our next question is still on intra-group profits. All right. So Aisha, what we simply did for that question, all that we did other scenarios, just to say that the fact that it was the subsidiary that sold to the parent, it means that we must ask ourselves one question. Whenever they sell to each other, we must ask ourselves this question. Do we have unsold parts or unsold everything that was sold between the two of them? Meaning that if, like in the instance we saw now, ESCO sold to PICO, as at the date we want to consolidate, do we still have the goods in the book of PICO? That's number one. If it is there, we now ask ourselves, when ESCO sold to PICO, did they sell at a profit? All right. If they have sold at a profit, this is what we said we must derecognize in our consolidated statement. All right. This 2,000 naira must be derecognized. And to derecognize it, we said you must take it away from the element of profit that should go to the parents, group retained earnings, and then the element of that profit that should have gone to NCI. And then you credit inventory with the total unrealized profit. Now, this element I'm talking about is the percentage of holding. In the last question, it will be 75% to 25%. And then the rest, the 100% is where you credit inventory. All right, let's look at another question. We are told PICO acquired 80% of the shares of ESCO on 1st January 2017. On January 1st, 2017, when the retained earnings of ESCO stood at 5,000 naira. The statement of financial position of the two companies on 31st December 2017 are given as follows. Okay. During the year, PICO sold goods. ESCO sold goods to PICO for 25,000 naira. The profit to ESCO being 20% of selling price. All right. You have to be careful. I think typical examination question may want to test your understanding of markup and margin. I see this as very easy. It's very simple. Just know that your markup is profit all over costs, and your margin is the profit all over selling price or sales. So just understand this and then understand how you're going to navigate between the two of them. Examiner may intentionally give you margin, knowing that what they gave you is cost. They did not give you selling price. They only gave you cost. They will now give you margin. And you know that margin, if for instance, margin is 25%, this 25% is profit all over sales. They did not give you sales. What they gave you is markup.
Hello, sir, are you there?
I think he's having a network problem.
Okay, thank you, sir.
All right. Let me reshare. The network threw me off. I don't know if any other person experienced that, but it did throw me off. Let me reshare. It's not glue, so it's not glue. It's Airtel. I don't understand. I'll get one of these home network thing. I think they are usually better. All right. Let me go back to what I was saying. So I was explaining a case. That's not the question here, but just pay attention to what I'm trying to do so that when we move on to tougher questions, we would have solved that problem already. So I said, if you were given, the question gave you margin, 25%, but what was given to you in the question was not sales. Instead, it was costs. So for me to do costs, I need markup, not margin. So the question will be, how do I convert from margin to markup? All right. I said to convert from margin to markup, understand that margin is always profit over sales. Markup, meanwhile, is the profit all over costs. All right. So I said, don't forget that selling price is usually the cost plus the profit. So when you tell me that I have a margin of 25%, I am going to assume that this 25 is the profit, all right? And this 100 is the sales. So therefore, if I want to get the cost, what I should do is say 25 all over 100. Now my cost from here, you know, we said selling price is cost plus profit. My cost from here should be selling price minus profit. So I'll do 100 minus 25, and that should give me 25 all over 75, which is 1 over 3, which should give me, if you press your calculator, 33.33%. So that way I have converted from margin to markup. So I can use this 33.3% on the cost that I was given in the question. All right. When we get to more technical questions, we'll play on this field. We'll play on this field. All right. Let's just move on so that we are not distracted from the question. All right. During the year, ESCO sold goods to PICO for 25,000. The profit to ESCO being 20% of selling price. So I have no problem here. I don't have a problem because the profit I was given is 20% of selling price, and I was given the selling amount. So I don't have any problem. I don't need to convert anything. There's nothing special here. At the end of the reporting period, now pay attention to this. 7,500 naira of the goods remain unsold in the inventories of PICO. Now, I want somebody to analyze how we are going to derive unrealized profit in this question. Very simple, but I want somebody to do it. Anyone in the class? Given that only 7,500 naira of the goods remain unsold as at the end of the period.
Hello, sir.
Haven't you, sir?
We ignore the 25,000. Then we apply the percentage to 7.5. Since that is
Very
the
good. Unsold.
so,
Yeah. Now, the simple reason for this is that, you see, the remaining part of this 25,000, which should be about 17,500. This 17,500 worth of goods, Pico already sold it to an external person. So whatever profit they make is from an external person, it's okay, it's fine. All right? It does not remain. However, this 7.5 that is still remaining, there's an element of it, 20% of it, ESCO is recording it as profits, and the goods have not left the group. Pico is here to sell it. So therefore, we are going to treat it as unrealized profit. That should be an amount, maybe 1,500. Okay. Now, of this 1,500, group owns 80% of the subsidiary. Group will take 80%. 80% of 1.5, I don't know how much for now. The remaining 20% is what belongs to Abi. What was the value of the holdings? Yeah, they said 80%. So the remaining 20% is what belongs to NCI. And that should be, I think, 300. Yes. 20%, 300. So I am going to debit NCI with 300, and I am going to debit group with 1,200. It's as simple as that. I think it's as simple as that. All right. So we've done almost everything. I don't think there's any big deal here. Let's go back and see what is left of the question. So we're told at the same date, Pico owed ESCO 6,000 naira for goods bought, and this debt is included in trade payables of Pico and the receivables of ESCO. NCI is valued at 9,000 naira at the date of acquisition. This other one is a very straightforward. I said, whenever this one happens, it's very straightforward. You simply cancel out that amount, 6,000 naira. Away from the current, and you cancel out 6,000 naira from the receivables current assets of ESCO as well. All right. Okay. Let's see. We can quickly do whiteboard. So first thing first, we want to calculate. We want to even look at what is the group structure like, and we've seen it. The group structure is such that Pico owns ESCO, 80% of it. Now, the date of acquisition, did they say is from since incorporation? Let me see. Okay, they said it was 1st January 2017. Now, the retained earnings as of this date, we're told is 5,000 naira. All right. Now, should this be the case? So I said, if it was not explicitly mentioned, just go to the parent statement of financial position. You see investments in subsidiary. They told us it was 23,000 there. And they also gave us the value of NCI. If you read the last sentence there, they said NCI is valued at 9,000 naira at the date of acquisition. All right, 9,000 naira. This makes 31,000. All right, net assets acquired. Go to the statement of financial position, look out for ordinary shares. So ordinary shares of ESCO. How much is worth? 15,000 naira book value. However, our pre-acquisition retained earnings was 5,000.
Hello, sir.
Okay. Go ahead.
23 plus 9 is 32.
Let's assume that I was testing you when I wrote 31. Hey, Jesus. All right, thank you very much, sir. 20,000 will be the addition of the 15,000. I hope I did not fail that one. So goodwill is 12,000 on consolidation. So I simply come to do my group retained earnings here. Now under my group retained earnings, Pico ESCO. Now, as per account or as at the date of consolidation, what we have in the book of Pico is 22,500. What we have in the book of ESCO is 11,000. We said Pico should have no rights into the pre-acquisition. So we take out the pre-acquisition. As a matter of fact, we have used the pre-acquisition to cancel out the consideration. And that was how we give it to goodwill. So if you take all of this 11,000, you are a liar. You are just wasting time. You're going to find out very soon. When you try to balance account, it will not balance. Okay? So always take out the pre-acquisition retained earnings. All right? Okay? So we come here, but the question again is this. Who sold to who? According to the question, is the subsidiary that sold to the parent. So therefore, that adjustment affects the subsidiary. If I treat it under subsidiary, that is the only way the net effect will affect both the parent and the NCI. If I do it any other way, I may not get it correctly. All right, so let's do it. Unrealized profits is simply 20% of 7,500. That's 1,500. Take that away, you're left with 4,500. All right. Now, share of profits. Share of profits. Permit me to say SOP will be equals to 80%. 80% of 4,500. What is 80% of 4,500?
36. 3,600.
3,600. All right, good. So here I would have 3,600. If I add that together, I get 26,100. All right? I think I'm correct. Now let's look for NCI. NCI as at date of acquisition. NCI was 9,000. Now they are going to get their own SOP as well, and that will be 20%. So the remaining 20% should be 900, Abby?
Yes, sir.
And that makes 9,900. All right. So with this done, I think it's easy. when I go back to the question now, we can easily see that all these ones, I'm consolidating them. So my non-current assets, PP should be 60,000. There's not going to be investment in escrow any longer. Current assets, don't forget that you have been told that inside these receivables, there is 6,000 to remove, meaning that what I'll be left with here is 9,000. So my current assets should be 9,000 plus 20,000, and that will give me 29,000. Also, there is goodwill on consolidation. Well, that one should have even come first. It should come before current assets. But anyway, I'll just go on. Goodwill on consolidation was 12,000. All right. Now, what is the addition of these three things?
$101. $101, sir.
Sorry.
101.
The inventory, sorry. Don't forget that inventory of parents, we calculated the other time. Inventory of parents, we are supposed to remove the unrealized profit, okay? We said unrealized profit was how much? We did 20% of 7,500, and we got 1,500, all right? We now said 80%, 20%. I am sure 20% of 1,500 is 300, meaning what we have here is 1,200, all right? So even from here, I'm supposed to remove 1,200, meaning that the current asset of the parents should be 18,800, all right? So 18,800 plus the 9,000 that is remaining for F as well. Is this understood? If I move on. Is this understood? There's no, the current assets, we don't have a special line for inventory. So yes. Inventory is current assets, all right? Trade receivable is current assets. So the two of them will be dealt with on the same line. The adjustment for trade receivable is that they told us there was intergroup trade or there was one transaction where ESCO is expecting 6,000 naira from PICO. So you will see it in the book of PICO, 6,000 naira is there as a payable. In the book of ESCO, 6,000 naira is there as a receivable. It does not matter to me. What matters to me is that I must remove 6,000 from receivable of ESCO, remove 6,000 from the payable of PICO because it's an intra-group transaction, all right? So now, for me to do that, I remove that 6,000 from 15,000. I had left 9,000. And then I came to the current asset of the parents. Sorry. And then I came to that of the parents. I took out the 1,200 we calculated here as the portion of the unrealized profit that should be debited to sorry. I think I should have just done it when I was doing the working, and I will not be this rusty. Sorry. All of the 1,500, all of the 1,500 is coming to inventory, Abby. Remember what we said. Debit group retained earnings with how much? 1,200. Debit NCI with 300. Then credit inventory 100%. I'm very sorry. Now, what we should take out from here is 1,500. So what will be left here is 18,500, not 18,800, 18,500. So I will add 18,500 plus 9,000, and that should give me 27,500. All right. So apologies once again. So here, my total assets should now give me how much? 7 plus 2 is 9. 8, 9,
99,500.
All right, thank you. All right. So I come to equities and liabilities. Ordinary share, I said we always pick up that of the parent alone, 50,000. The group retained earnings that we calculated, we did 22,500 plus. Somebody wants to remind me, please? Who still remembers that figure? Let me see if I can remember. We did 80% of 4,536. Okay, 22 plus 36, 26,1.
22,500 plus 36.
26,1. Okay, I remember. 26,1. So altogether, this is 76,100. And then we went on to do NCI. NCI was 9,900. Yeah, valued at 9,000 at acquisition. Then the remaining share of that 4,500 was 900. That was how we got 9,900. So together, these two gave us 85,900. And then we have current liabilities of 19,500. This will not balance. So what have I done wrong again this time around?
Plus 99.
Yeah, to remove the 6,000.
Okay, yeah, that's true. The 3,000 here plus 10,500. That gives us, it still looks like something is of 13,500.
I think, sorry, I think we are supposed to add it, Abi.
Hold on. I have seen my one thing there.
Okay.
I didn't write this one very well. This one is 100. Okay, so this should have been 86,000. This should have been 86, Abi? Yeah, 86,000. So 86 plus 13,500. That will give us 99,500. All right.
Yes.
All right, so we can be simple, and if your mind is not totally clear, you can still make errors. However, that is that on intra-group trading. I have seen questions that I have earmarked from past questions. And the reason I have not still brought it up is that I am seeing adjustments like this there. Okay, I think I'm getting more confidence now that by the time we start introducing those questions, nobody will say, but we've never done this before. Because all of those adjustments in the past, is it 6 or 7 weeks now? I think we've touched about, after we're done with the next one, I think I'll be able to say we've done like 99% of it. So when we take a full-fledged question, we shouldn't have a problem. All right, let's move on. We still have another intra-group trading, but this time around, what is traded is not item of inventory. What is traded is non-current assets. So we might have a situation whereby the parent transfers non-current assets to the subsidiary, or the subsidiary transfers non-current assets to the parent. All right. Now, it's not so different from what we have done when we were doing trading of inventory. The only thing is this. What's different here? The same principle of, if they have transferred it at cost plus profit, it should be impossible for one of them to make profit from the other. So therefore, we are supposed to eliminate or cancel out that unrealized profit. It's still the same sense. It does that this time around, instead of crediting inventory, what you will credit is the non-current assets. All right. And if it is the subsidiary that has made that sale, then what you should also do is to debit both the group retained earnings and the NCI by the portion of their holdings. Okay, we have exemplified that already when we were dealing with what is it called now? Intra-group trading as it relates to inventory items. Okay. Now, there is one more layer to this. What's the other layer that is there? Don't forget that, let's read what they wrote here. They said, since, let me annotate. They said, since the non-current asset was recognized at a profit loading, it would have affected the depreciation on the non-current asset. So the excess depreciation must also be eliminated. Okay, the double entry to eliminate excess depreciation. This time around, we are writing back an expense. And when you are writing back an expense, you are taking it away from debit expense. So what you're basically doing is you are crediting your POL and then you're debiting your non-current assets. All right. Now, what is the meaning of this? What do they mean by this excess depreciation? Let's look at it practically. An item of inventory that should cost 50,000. If we go by the books, the current carrying amount of this item is 50,000. But then we sold it at, let's say, 80,000. All right. Now, the remaining useful life of this asset, this non-current asset, is 2 years. All right. If it is 2 years, then in the book of, let's say it is Pico that bought the non-current asset from ESCO. All right. What it means here is this. When we want to write back the unrealized profits, all right, we would have said this 30,000 naira is unrealized. And then we would have debited the group retained earnings and we would have debited NCI. All right. Why are we doing this? We are doing this because it is subsidiary that sold to parent. So we'll share the unrealized profit that is to be written back. All right. And then we'll credit non-current assets. All right. Now, you have done this to eliminate the excess and the unrealized profit. However, what you must also not forget is that there is an element of depreciation that you would have calculated that is based on 80,000. What do I mean by that? If this asset remained in the book of ESCO, ESCO would have done 50,000 divided by 2 per annum they are going to charge depreciation of 25,000 naira. However, now that they have transferred it at 80,000 naira to Pico, Pico will said, I will do 80,000 divided by 2. And Pico will now charge 40,000 naira per annum. Meaning that if we are writing back this 30,000 in our consolidation, we must also be mindful of the fact that we may have done 40,000 naira depreciation as against 25,000 naira depreciation. The difference between 40,000 and 25,000 naira, that 15,000 naira per annum is excess depreciation. So that excess depreciation is what we are saying. We are going to need to debit back the non-current assets with it. And then what do? You credit the group retained earnings. All right. So let's look at it so that when we look at it in a question, it is going to be easier after I have demonstrated. I know some of us may not still get it like this, but don't worry. When we solve the question, you should understand. All right. Okay, problem 19. We're told Pico acquired 80% of the shares of ESCO on January 1st, 2016, when the retained earnings of ESCO stood at 5,000 naira. The the statement of financial position of the two companies on 31st December 2017 are given below. Statement of financial position, we have that of Pico and ESCO side by side, all right? They were told on 1st January 2017, ESCO sold plants costing 5,000 naira to Pico at 6,250. The group charges a depreciation of 10% on all non-current assets, all right? NCI is valued at 9,000 naira at the date of acquisition. Please, I think this question, okay, they have removed one or two things. Very similar to the question we've just done. I don't want to waste time. We have the same numbers for investment in ESCO. We have the same numbers. Let me quickly do it here. I don't want to waste time at all. Goodwill. All right, okay. Let's do it on the whiteboard. Notwithstanding.
We have enough time, 30 minutes.
So like every other question, we'll start with, okay, what is the group structure? Blah, blah, blah. Group structure, we're told that Pico owns 80% of ESCO. Now, as at the date of acquisition, what is the date of acquisition? According to the question. Okay, all right. As at the date of acquisition, we're told date of acquisition was January 1st, 2016, and then the retained earnings as for that day for ESCO at 5,000. Okay, you can take that information into calculation of goodwill on consolidation. So my goodwill on consolidation.
The network is not speaking. So
how about now? Is it better? I think it's my voice I needed to raise. Is it better now?
Yeah.
FD of purchase considerate FD of purchase consideration. We're told, they didn't tell us how much, but the question is stated that investment in expert cost was 23,000, similar to what we've done. In terms of value of NCI, last sentence for the question said it was 9,000. I will not make the same mistake again. This total is 32, not 31. Right? So net assets acquired. Ordinary share capital. Ordinary share capital is an amount 15,000. And then retained earnings that were given 5,000. You take that away from 32, you have 12,000. All right. So we were told that they sold non-current assets. Non-current assets, what, how much? That in their own books, it's unrealized profits will be 6,000 minus, is it 6,000? 6,250, sorry. 6,250. Minus 5,000 equals 1,250. So I'm going to debit. Who sold to go here? Esco sold, okay? For this one, I'm going to debit group retained earnings, 80% of 1,250. I'm supposed to credit NCI, sorry, debit NCI, 20% of 1,250. All right. And then credit non-current assets, 1,250. Okay, so 80% of 1,250 is how much? 1,000. All right.
That's 1,000.
1,000. Debit NCI 250. All right. But don't forget that we have been told that it is a group policy to calculate depreciation at 10%. All right. Depreciation is calculated at 10%. So it means that our excess depreciation, don't worry yourself. You can do one of two. Don't even do one. I will not even say one of two. I will just explain. But this is what you should carry on doing. So I can do it like this and say original costs. Sorry. The sale value was 6,250. So therefore, Pico would have calculated this 625 naira. Abi? Now the costs, if it had remained at cost in the book of the subsidiary, they would have calculated 10% of 500. I mean, of 5,000, that would have given them 500. So therefore, this is my excess depreciation. All right? Or I can calculate my excess depreciation like this. I can say 10% multiplied by the unrealized profit, which is how much? 1,250. And that gives me 125. As a matter of fact, this is what you should simply do in your exam. Don't bother yourself doing it. However, if you don't remember, it's still the common sense thing to break it down. You can go ahead. There is no problem with that. I don't see it slowing you down too much. But, if you can save time and move as fast as possible, then the better for you. All right. Okay. So my group retained earnings is quite easy from here. We were told that Pico had how much? I think they said 22.5. Pico had 22,500. Esco had 11,000. All right. This was as at 31st/12/2017. Now, pre-acquisition, they had 5,000 in their books. So all the post-acquisition profit was 6,000. And yet they had an unrealized profit of 1,250. If you take that away, you'd be left with 4,750. Now, SOP for parents should be 80% of that. 80% of 4,250, 750 is how much? Or am I rushing it?
3,800.
So 3,800. Now, don't forget that we are supposed to write back this 1,125, all right? Which I am sure it was the parents that would have done that excess depreciation calculation. So, what did you say? Hello, what did you say? Can everybody mute, Jerry? Okay, let me find a way to squeeze this in. Maybe I should squeeze it here. Excess depreciation 125. All right. Now that excess depreciation, I'm not deducting it is because it's an expense that we are writing back to income. All right. Okay. So what do you get when you add all of this together? $22.5 plus 38 would have given us 26,300. If I add 300 plus 125, that's 26,425. All right. There's only one calculation left. There's only one calculation left, and that's 26. NCI. No. Yeah, you're correct. 26,425. Only one calculation is left, and that's NCI. So NCI would be 9,000 plus open bracket 0.2 multiplied by 0.2 multiplied by 4,750. That is the share of post-acquisition, what am I pressing? 0.2 times 4,750 gives me 950. All right, that 950, I will add it to the 9,000. That gives 9,950. Is that correct? Now let's come to the question. Let's go back to the question. I hope I can remember. Hold on. Okay, unrealized profit is 1,250. I'm to credit that against the current non-current assets, and then I'm to write back excess depreciation of 1,125. Also, the group retained earnings is 26,450, and then NCI is 9,950. All right, let's come to it. So when I come here, my non-current assets. Now, from the position of the group, this 40,000 includes unrealized profit of 1,250. And then we have done excess depreciation of 125. So I will minus 1,250. And then I will add back the 100. So when I do that, 40,000.
Bishop.
Somebody help me, 40,000 minus 1,250 plus 125. I got 38,875. Are we together?
Yes.
Yes, sir.
Oh, am I still sharing screen, right?
Yes.
Okay, good. So I got 38,875. All right. Investment in escrow, it will no longer exist. Instead, it will be replaced with goodwill. Our goodwill is 12,000.
Hello, sir.
All right. Our current assets, nothing is affecting it this time around. So current assets should be 35.
Hello, sir.
But go ahead, I'm with you.
Did you add the 20,000 to your PPE?
I have not added 20,000, sorry. That makes 58. All right, sorry. Okay. Altogether, what do we have? Altogether, what do we have?
105,875.
105,875. All right, ordinary shares. Ordinary shares will take that of the parent. My battery is getting low. Okay. Well, we can still round it up. We take that of the parent, 50,000. All right. Now we have retained earnings. Thank God I stored it in my head. 26,450. This becomes 76,450. Is it 425?
425.
Choose 20. Okay. 29th. 76, 425. But then I said NCI, if you add 9,000 plus 950, you should get 9,950. All right. Let me adjust this. So this is 425. So what do we get if we do this?
86,375.
6375. And then we have current liabilities. I don't think anything affected it this time around. Or did they tell us? I don't think they told us anything special about it. That should be 19,500. That'll give us 875 here. 510. So balanced. All right, good. All right, good. Is this clear to every one of us? Is this clear? The only thing that is extra here, not really so extra, is that you just have to pay attention to excess depreciation. Now, your examiner may play a trick on you. It will not be a full year. You know, we just did 10% of unrealized profit.
Okay.
Another question, it may be that it was for 6 months. The time between when they purchase and when you are consolidating, it may only be 6 months. So you will still need to calculate times 6/12. Or it could be 3 months. Instead of times 6, it will be times 3/12. So that your excess depreciation accrues perfectly well with the timing between when the transaction took place and the date of consolidation. Okay, so those are some of the things we will see when we start to attempt examination question. That is the ultimate for me. That's where I want us to move on to. It's just this is when we get to SOPL, thankfully we won't have to do too much. When we get to associate investment, there's not so much to do there as well. This is where the real work is. Once you are grounded here, you're already seeing that some adjustments is supposed to affect P or L. The only thing is that because we are focusing on SOFP, is affecting retained earnings only. So when we get to SOPL, we shouldn't have a problem. We'll do the same adjustment. The ones that are supposed to affect P or L will go directly to the consolidated P or L. It will not be that we are using one other thing to represent it. That's just the major difference. That's just the major difference. And then paying attention to allocation between NCI and parent. That's just the only thing there. When we get to associate investment, you see that equity accounting is rather easy as well. From that point, I'm good. Okay, there are 123 pages. We're on page 80. Good as well. We're almost there. Let's see if the next thing is something we can round up. We can do a round up. If not, I'll just introduce us to it, and then in the next class, we'll go into it as well. All right. If there are no questions, I think I should just move on.
Please, I have a question, sir.
Please go ahead.
Can we have a reverse, like we're saying you cannot make a profit, parents and subsidiaries. Can there be a loss?
There can be no profit, there can be no loss.
Okay.
There can be no profit, there can be no loss. Because the same way you can't make profit off each other, you shouldn't make loss off each other. Now, understand the principle of consolidation. Consolidation is saying you and your parents, or parent, you and your subsidiary, in fact, including your non-controlling interests that are third parties, all of you come together in this book, meaning that that consolidated financial statement carries every one of them together as one company. So it will be impossible to make profit or loss of the same company. Do you get? It is only when you trade with third parties that you're expected to have either profit or loss. However, in the separate financial statement, those profits or losses will exist. I don't know if you get what I'm saying. In their separate financial statement, that thing we are calling unrealized profit in consolidation will not be unrealized there. It will be there. There will be no elimination. It is going to be there. So that's the explanation. Is it clear with the part where I said in the separate books
Yes.
you will still have
yes.
it?
Yes.
Very good.
Yes.
All right.
Thank you.